They insist the rally is finished, warning gold and silver will crash 40% as peace spreads and courts dismantle tariffs, destroying the entire bull market thesis. Mainstream media and institutional analysts claim geopolitical calm, and Supreme Court rulings eliminated safe haven demand, insisting the precious metals surge has reached a final irreversible peak. My team spent the last 24 hours examining raw data, and what we discovered reveals the most aggressive psychological media trap unfolding across markets this year. Today, I will explain why powerful institutions suddenly beg you to sell, and how fear narratives are deployed to separate investors from physical metal before critical deadlines. Before analyzing crash claims, we must talk honestly because we are building a mastermind community of critical thinkers, not passive viewers, accepting headlines without independent verification. I will be active in the comments, reading your insights, and replying thoughtfully, encouraging everyone here to challenge assumptions and refine conclusions through collaborative reasoning and debate. We make stronger decisions when we question narratives together, so let us debate whether this 40% crash warning reflects reality or a coordinated attempt to shake confidence. Comment crash or trap below and explain your reasoning, because understanding the macro environment requires disciplined thinking rather than emotional reactions to alarming financial headlines. Pause the video, share your thesis, support truthful analysis, and ensure you remain subscribed so you receive updates as this volatile situation evolves over coming days. Now, let us open the case file and examine the coordinated narrative currently circulating, a message both elegant and terrifying, crafted to appear logical, data-driven, and unavoidable. Major institutions claim the rally that pushed gold above 5,000 and silver past 120 is not merely over, but poised for catastrophic reversal. They cite three developments as proof of a regime shift destroying the investment thesis: geopolitical de-escalation, tariff collapse, and a hawkish Federal Reserve leadership transition. First, the geopolitical de-escalation narrative suggests Russia is quietly resuming dollar trade settlements, signaling de-dollarization efforts failed and undermining a major pillar supporting gold's rise. Media outlets frame this as strategic surrender, claiming the weaponization of the dollar proved unstoppable and the multipolar currency experiment collapsed under economic and political pressure. Simultaneously, rumors of diplomatic progress between the United States and Iran suggest Middle Eastern tensions are easing, weakening safe haven demand that previously supported elevated gold prices. The message is unmistakable. Geopolitical risk is fading, and with it, the premium embedded in gold and silver valuations, removing a primary driver of recent price appreciation. Second, the sudden tariff collapse narrative centers on a Supreme Court ruling striking down sweeping global tariffs, portrayed as dismantling the economic foundation behind the Sell America trade. Analysts argue that without aggressive tariffs, the dollar strengthens, capital returns to domestic assets, and gold must decline as protectionist pressures and fiscal fears recede. Although alternative tariffs remain, markets interpret the ruling as structural constraint, weakening expectations for prolonged trade conflict that previously fueled precious metals demand. Third, the Kevin Wersch factor introduces expectations of a hawkish Federal Reserve pivot, with tighter policy and balance sheet reduction threatening non-yielding assets like gold. Higher real yields historically pressure gold, and a stronger dollar driven by rate hikes could compress prices significantly, reinforcing institutional claims of a looming bearish repricing. According to modeling scenarios, rising real yields and capital rotation into equities and bonds could drive gold down 5 to 20% even before broader liquidation accelerates. Combine collapsing geopolitical premiums, hawkish monetary policy, and stronger currency dynamics, and analysts construct the frightening projection of a 40% decline in precious metals. From current levels, that scenario places gold near $3,000 and silver near $50, aligning with technical support zones and pessimistic institutional forecasts. The argument appears logical and data supported, which is precisely why we stress-tested every claim against real market mechanics and positioning metrics. When frightening headlines appear, do you trust the narrative or examine supply and demand math beneath the surface, revealing incentives driving institutional messaging and timing? Because the mathematics tell a more complex story, one contradicting simplistic crash narratives and exposing structural tensions beneath the surface of the precious metals market. Gold reached record highs before experiencing a sharp correction, then partially recovered, demonstrating resilience inconsistent with a market preparing for catastrophic collapse. Silver likewise crashed dramatically before rebounding, remaining below peak levels, yet showing persistent demand that challenges claims of evaporating investor interest or industrial necessity. If a 40% crash were certain, why are sophisticated buyers accumulating silver at current levels while gold steadily recovers from its flash crash lows? Asian markets continue physical accumulation despite identical news access, suggesting regional buyers interpret geopolitical developments differently and prioritize long-term supply security over short-term narratives. Technical analysis reveals gold's recovery stalled below critical retracement thresholds, a pattern consistent with distribution, where institutions sell into strength rather than accumulate new positions. Positioning data confirms declining net longs and systematic de-risking, indicating hedge funds are reducing exposure in anticipation of volatility rather than building aggressive bearish bets. ETF flows reveal defensive repositioning, with gold attracting capital while silver experiences outflows, signaling selective allocation rather than broad confidence across precious metals. Heavy liquidation volume during the crash, contrasted with lighter recovery volume, suggests distribution patterns, where institutional selling overwhelms demand during declines and weakens subsequent rebounds. The gold to silver ratio widening indicates declining confidence in silver's valuation, reinforcing institutional caution and expectations of underperformance relative to gold in near-term conditions. Taken together, these signals suggest a fragile recovery vulnerable to downside shocks, yet not definitive evidence of an imminent catastrophic collapse across precious metals markets. However, an additional risk largely ignored by mainstream narratives could significantly impact silver specifically, accelerating industrial substitution due to rising material costs and technological adaptation. Silver demand relies heavily on industrial applications, particularly solar technology, where rising costs encourage manufacturers to reduce or replace silver usage with alternative conductive materials. Major manufacturers are already developing copper-based or silver-free photovoltaic technologies, targeting commercial rollout timelines that could structurally reduce future industrial silver demand. Forecasts indicate solar capacity may expand even as silver usage declines, demonstrating substitution dynamics capable of weakening the industrial demand floor supporting silver prices. If substitution accelerates while speculative demand declines, silver could lose both its industrial support and investment momentum simultaneously, amplifying downside risks compared to gold. Despite projected deficits, those forecasts assume stable demand and continued investment inflows, assumptions that may fail if substitution and economic slowdowns materialize concurrently. This context makes the 40% scenario plausible under specific conditions, though not inevitable, emphasizing the importance of monitoring multiple converging variables rather than single narratives. Timing is critical, because the media fear campaign coincides with an approaching futures delivery deadline, where physical supply constraints could trigger price spikes instead of declines. If traders demand delivery and inventories prove insufficient, a short squeeze could send prices sharply higher, contradicting narratives urging liquidation ahead of the deadline. Conversely, convincing investors to liquidate reduces delivery pressure, stabilizes exchanges, and benefits institutions holding structural short positions requiring physical metal to settle obligations. This timing suggests fear narratives may serve strategic purposes, encouraging selling before delivery windows, rather than reflecting purely objective market analysis or investor protection motives. Geopolitical developments and policy shifts are real, yet their amplification into catastrophic warnings immediately before delivery deadlines raises questions about incentives and coordinated messaging strategies. Understanding institutional incentives clarifies why persuading longs to cash, settle benefits, short-positioned banks, reducing physical delivery demands, and preventing disruptive supply squeezes. This is not speculation, but market mechanics, where future structures, delivery obligations, and inventory constraints shape behavior and messaging across financial institutions and media channels. Historical precedent shows large crashes occur during aggressive tightening cycles, requiring sustained rate hikes, strong dollar rallies, and rising real yields to produce extreme declines. Absent those aligned conditions, markets typically experience corrections in volatility rather than catastrophic collapses, highlighting the conditional nature of extreme bearish projections. Current positioning shows institutions reducing exposure without aggressively building short positions, signaling uncertainty and risk management rather than confident anticipation of a massive crash. Producers are locking in future revenues through streaming agreements, a classic de-risking strategy reflecting volatility expectations rather than directional certainty about future price movements. This behavior suggests markets are preparing for range-bound volatility with downside risk, not a predetermined collapse, contradicting simplified narratives dominating financial headlines. For a 40% crash to occur, multiple variables must align simultaneously, including hawkish policy implementation, geopolitical stabilization, substitution acceleration, and collapsing speculative demand. Such alignment is possible but uncertain, meaning current warnings function more as stress test scenarios than definitive predictions of imminent catastrophic price declines. This distinction matters because stress tests inform risk management, while fear-driven narratives can manipulate investor behavior during critical market windows with significant institutional consequences. The physical supply situation has not fundamentally changed, and policy shifts remain months away, raising questions about why urgent selling is being encouraged precisely this week. If banks face delivery pressure and require physical metal, encouraging liquidation becomes a rational strategy, aligning messaging incentives with structural needs rather than market transparency. This does not invalidate geopolitical or monetary risks, but it reframes their amplification as potentially strategic rather than purely informative for retail investors. Understanding this context empowers investors to evaluate motives behind narratives, distinguishing between genuine risk assessment and positioning-driven messaging designed to influence market behavior. The Asian markets reopen soon, and futures trading will resume, making this a critical period where investor decisions could influence supply dynamics and short-term price trajectories. Are you reducing exposure out of fear, holding physical assets through volatility, or waiting for confirmation signals before adjusting positions in response to evolving macroeconomic developments? Share your strategy and reasoning below, engage with others' perspectives, and remember that collaborative analysis strengthens decision-making during periods of uncertainty and heightened narrative manipulation. Subscribe for ongoing updates as we monitor delivery deadlines, policy developments, substitution trends, and positioning data shaping the next phase of the precious metals market.